Microsoft just posted its worst quarterly stock drop since the 2008 financial crisis. Down 25% in 3 months. Here is the strange part: the business is booming. Azure grew 40%. AI revenue passed $37 billion a year. So why is Wall Street running away? In the next 10 minutes, I will show you exactly what broke. And why 53 of 55 analysts still say buy. If you find this useful, subscribe. Let's get into it. The story starts in 1975. Bill Gates and Paul Allen, two young programmers, see a magazine cover of the first hobbyist computer. They write software for it in 8 weeks, without ever touching the machine. It works. Microsoft is born in Albuquerque, New Mexico. The mission sounds insane for the time: a computer on every desk and in every home. In 1980, IBM comes knocking. They need an operating system for their new PC. Microsoft does not even have one, so they buy a rough system for $75,000, polish it, and license it to IBM. The genius move: Microsoft keeps the rights. Every PC clone that follows pays Microsoft too. One contract turns a tiny software shop into a money machine. Windows launches in 1985. Office follows. By the 90s, 9 out of 10 computers on Earth run Microsoft software. The 1986 IPO makes thousands of employees millionaires. By 1999, it is the most valuable company in the world. Then comes the antitrust hammer: the government nearly breaks the company in two. Microsoft survives, but the fear of regulators never leaves. Then, a lost decade. Microsoft misses smartphones. It misses search. The stock goes nowhere for 10 years. In 2014, Satya Nadella takes over and makes one call that changes everything: stop defending Windows, bet the company on the cloud. Azure is born from that bet. And a $300 billion company grows more than tenfold from there. Today's Microsoft runs on 3 engines. Productivity, that is Office, Teams, and LinkedIn. Intelligent Cloud, that is Azure and servers. And personal computing, Windows, Xbox, and Surface. Fiscal 2025 revenue, nearly $282 billion, up 15%. Net income, over $100 billion. Microsoft earns more profit in 1 year than most famous companies are worth. The real magic is how Microsoft sells. Almost everything is a subscription. Office became Microsoft 365, monthly fees. Gaming became Game Pass. Developers pay monthly through GitHub. Microsoft Cloud alone brought in $169 billion last fiscal year, growing 23%. Predictable money, year after year. Wall Street used to love this story. Azure is the number 2 cloud on the planet, behind Amazon. But look at the growth. In the March quarter, Azure grew 40% year over year, at a scale of tens of billions. Growth the big rivals cannot match right now. Every company building AI needs computing power, and Azure rents exactly that. Demand is so hot that Microsoft literally cannot build data centers fast enough. On top of Azure sits Copilot, AI built into Word, Excel, Outlook, and Teams. Over 20 million people now pay for it, roughly $30 per seat, per month. Add it all up, and Microsoft's AI revenue run rate passed $37 billion, more than doubling in a year. That is already bigger than most software companies. And penetration is still in single digits. Now the latest quarter. Revenue, $82.9 billion, an all-time record. Net income, $31.8 billion. Margins most companies can only dream of. Guidance beat expectations too. In any normal year, this report sends the stock up. This time, investors barely blinked. Because by then, they were staring at a very different number. That number was the stock price. From a peak of $555, Microsoft fell as low as $349. The first quarter of 2026 closed down 25%, the worst quarter since the global financial crisis. More than $1 trillion of value, gone. Microsoft slipped out of the world's top 3, down to number 4. So what spooked everyone? Reason 1, spending. Microsoft now plans to pour roughly $190 billion into data centers and chips this fiscal year. Wall Street expected 155. Memory prices are soaring, making every server more expensive. It is the largest capital spending program in corporate history, by any company, in any industry. And it all lands on this year's books. All that construction eats cash. Last quarter, Microsoft earned nearly $32 billion in accounting profit, but free cash flow was under $16 billion. Half the profit, gone into concrete and silicon. And those chips age fast. Investors started asking an uncomfortable question. What if this is the most expensive infrastructure bet ever, and it does not pay off? Reason 2, OpenAI. Microsoft owns about 27% of it, after investing more than $13 billion. Sounds great, until you read the fine print. Nearly half of Microsoft's $625 billion order backlog comes from OpenAI alone. And the partnership is no longer exclusive. This February, OpenAI reportedly signed a $50 billion cloud deal with Amazon. The golden child is dating the rival. Short term, watch 3 things. First, the fiscal fourth quarter report in late July. Azure guidance says 39 to 40% growth, anything less feeds the bears. Second, any signal that capital spending has peaked. Even a hint could spark a relief rally. Third, Copilot seats. 20 million is nice, the market wants 50. Every earnings call is now a referendum on the AI bet. Long term, the bull case is simple. Microsoft owns every layer of the AI stack, data centers, models, and the apps a billion people use at work every day. If AI becomes the new electricity, Microsoft is the grid, the power plant, and the wall socket. AI agents that do entire jobs, quantum computing, cloud gaming, every one of those futures runs through this company. But hold on. Risk number 1. This only works if demand keeps growing. Those $190 billion buy chips that lose value in 5 or 6 years. If AI adoption slows, Microsoft is left holding the world's most expensive pile of aging silicon. Depreciation would crush margins for years. In 2000, telecom companies overbuilt fiber and collapsed. Every AI bear keeps that chart on their wall. Risk number 2, competition from its own partner. OpenAI now builds enterprise products that compete with Copilot, while Google bundles Gemini into Workspace, often cheaper. Copilot has reached only about 4% of Microsoft's commercial user base. If office workers decide AI assistants are interchangeable, the $30 seat becomes a $10 seat. The moat is real, but it is being tested from every side. So what is the price tag? About 21 times forward earnings, the cheapest Microsoft has looked in years, for a company still growing double digits. 53 of 55 analysts rated a buy. The average price target is $561, more than 40% above today. Even the lowest target on the street sits above the current price. Wall Street's message: the fear is overdone. If you want in, Microsoft trades on the Nasdaq under the ticker MSFT. Fractional shares mean you can start with $10. Prefer a basket? Microsoft is a top holding in nearly every S&P 500 and Nasdaq ETF. And unlike most AI plays, it pays a dividend that has grown for 15 straight years. This is the rare AI stock your grandmother's pension fund already owns. So, worst quarter since 2008, or best entry point in years? History says betting against Microsoft is expensive. But history also says infrastructure bubbles end badly. It comes down to one question: will the world's appetite for AI keep growing faster than Microsoft can build? Nobody knows yet. This video is for education only, not financial advice. Do your own research. If you learned something, subscribe. A new deep dive drops every week. See you in the next one.